Ever watch a chart suddenly rip higher or dump hard? No Fed headline, no big geopolitics, and feel stuck guessing why? Most of the time, the answer is one thing. A company just reported its quarterly earnings. Today's topics, earnings season and earnings surprises, are among the biggest scheduled events that move markets anywhere on the planet. Think of the S&P 500 on your screen, 500 large U.S. companies, and the gauge global investors check first, as the place those prints land hardest, and then ripple into Europe, Japan, and emerging markets. Ready? Let's dig in. Like the Apple, APL, daily chart in front of you, public companies in the U.S. report results 4 times a year, and mega-cap prints like this are watched from London to Tokyo to Sao Paulo. Q1, Jan, Mar. Q2, April, June. Q3, July, Sep. Q4, October, Dec. Think of it as a report card every 3 months. How much did we earn? Filings usually land 30 to 45 days after the quarter ends. That window is earnings season. January is packed with Q4, April with Q1, July with Q2, October with Q3. Japan and parts of Europe often run on different fiscal years, so their calendars don't always line up with Wall Street's peak weeks. Historically, the first 2 weeks of a U.S. earnings season tend to shake the S&P 500 harder than a quiet stretch. Why? Because the market instantly reprices when what we expected, consensus equals the average of roughly 100 analysts, meets what the company printed, EPS, earnings per share. Big gaps up or down around the print date on chart. That's surprise evidence. Look at the NVDA chart on screen. Those sharp jump or dump days right after a print? When companies report, they usually toss one more ball, guidance, the outlook for the next quarter. Same idea as a coffee shop saying, next month's new blend is coming before you smell it. If NVIDIA says, we're targeting about $25 billion of Q2 revenue, sell-side analysts update price targets almost immediately, and that number shows up in every global news feed. Here's the core. The average of those analyst forecasts is called consensus. Beat it, and the stock often pops, like scoring a 90 when the class average was expected at 70. example, 컨센서스 EPS $2.50, 컴퍼니 프린트 $2.19 그러면 러플리 A 플러스 6% 서프라이즈 그러면 바이어즈 파일링 그러면 세임데이 무브즈 오브 어바웃 38% 알커먼 프린트 원이 $2.40 그러면 어바웃 A-4% 미스 그러면 드라프스 오브 65% 해픈. Absolute numbers can look good, and the stock still falls if they undershoot what the market already priced in. On this Nasdaq 100 daily chart, those surprise spikes and air pockets, a large share clusters around earnings season, and international analysts often echo the same tape when U.S. tech leads risk appetite. An earnings surprise is when results clear the bar the market set. Example, expected EPS below 1.00, actual below 1.15, a welcome jolt, like finding your grocery run costs less than you budgeted. Statistically, beats of about 5% or more often draw fresh buying, with same-day gains in a rough 2 to 8% band on the name. Miss by 5% or more, and selling can push same-day drops of about 3 to 15%. Tech and growth names, think the ATHOG heavyweights, tend to punish misses harder. Historically, roughly 60-70% of print beat SH and 30-40% miss. That uncertainty is why option-implied volatility swells before the date. Traders hedge moves they can't forecast. Watch the high-low range expand in the 3 to 7 days before the print. On this S&P 500 weekly 1W chart, Turn on event marks, and you can track earnings dates the way a global calendar tracks Fed weeks. 퍼스트 트레이딩 뷰 차트 세팅스 기여 그러면 이벤트 그러면 책 어닝즈 오르 코퍼레이트 어닝즈. Tiny marks appear. Toggle them on and off and study the pattern yourself. Second, from about 3 to 7 days before a scheduled print, daily high, low range often runs 20 to 30% wider than that name's quiet average. If the print is Thursday, Monday's tape can already feel jumpy. Third, bigger swings in the first 2 weeks of earnings season are normal. Don't panic with why is everything shaking. Recognize this window can deliver outsized gains or losses on purpose. Fourth, one company's print can rotate whole sectors worldwide. Soft AI guidance from names like Microsoft or NVIDIA can drag QQQ and related global tech peers. Strong bank prints can lift XLF and financials abroad. Track the sector tape, not just the single ticker. On this SCHD, Quality Dividend Daily, how you use earnings season depends heavily on your style, whether your account is in dollars a U.S. broker or you hold U.S. names from overseas. Approach 1. Conservative react after. Wait 2 to 3 days after the print until the market's verdict is clear, then follow. Smaller upside, fewer gap loss surprises. Approach 2. Active earnings bet. 1 to 2 weeks before, screen ROE and revenue growth for names you think the street underestimates, then buy ahead. Example. Street at la 2.00 EPS while your read of the business points nearer to la 2.50. You position early. A miss can still gap you down 5 to 15%. Approach 3. Mixed dodge the chaos. Steadier dividend sleeves like SCHD often swing maybe 2 to 4% too around prints. QQQ and high growth names can whip 15 to 30% too. Match the sleeve to your goal and sleep. Caution, the earnings day gap is both opportunity and loss machine. No guessing. Compare consensus to the actual print, then decide. Risk only what you can afford to lose. Keep this Apple, APL, daily in mind. A quarterly print is not just accounting. It is the market's fastest rescore of our expectations versus the company's reality, and it moves dollar portfolios from New York to Singapore. Follow the Q1, Q4 cycle. January, April, July, and October pack the U.S. earnings seasons. 테이프를 5부섬. 비트 컨센서스 그러면 비즈즈. 미스 그러면 5% 오픈 뉴드인 미니츠. Watch it live on the chart. Range expands 3 to 7 days before, then a gap on print day. That pattern repeats season after season. Next lesson, we cover sector rotation and the business cycle. Once you see how earnings reshape which sectors get capital globally, your sizing decisions get sharper. Warning disclaimer. This lesson is educational, not investment advice. Dividend and capital gains tax rules differ by country and year. Always check current law, including W-8 bin withholding if you are a non-U.S. holder of U.S. shares. Earnings alone cannot forecast price. Fed policy, geopolitics, and sentiment all matter. No returns are guaranteed. Every trade is your responsibility. Subscribe and like if this helped, and drop questions in the comments.